and welcome to the EBA. Thank you, Oli, for these nice introductory remarks, and especially for organizing this event. It's the 13th, if I'm not mistaken. So I'm a bit surprised because I think it's an annual conference, but it's more than the years of the EBA, which is 12. So I guess we really started from the very beginning. This always happens. I'm 59 years old, but I like to tell my kids that in the 60 years of my life, because we always count the years as past. So this is a clear explanation of this. We start from the very beginning of the EBA with the intention of having these research policy conferences, and I think we've been able to deliver very systematically for the last almost 13 years of life of the EBA. So welcome to the 13th conference. I think it'll be really, really good. I hope it is. I looked at the content of the agenda, and it's very exciting. As you know, the title for today, or the theme for today and tomorrow, is interest rate and liquidity risk management, regulation, and the macroeconomic environment. I don't think it could be more timely than that in terms of the topic, because you know that 8 months ago, starting around March of this year, the global banking industry across the Western countries was rattled by a series of unexpected events, which for a moment, I think, threatened the stability of the entire financial system. I said for a moment, maybe for a weekend, maybe for a week. In the United States, particularly, when we think about liquidity, 3 million-sized banks experienced deposit runs and had to be rescued by the federal supervisory authorities. Soon thereafter, in fact, a week later, a global systemic bank also succumbed to a deposit flight until it was merged with a competitor in a government support operation here in Europe, not in the European Union, but here in Europe. Until the last days of these banks' existences, all of them basically comfortably fulfilled their regulatory capital and liquidity requirements. However, as we know from that experience, depositors lost confidence in them, and there were significant weaknesses. Now, forensic analysis of what had happened led to the identification of several vulnerabilities. First, and I think probably most important, unfocused management and weak risk management practices, which resulted in a deep weakness to the sharp rise in interest rates executed by the major central banks, as opposed to the risks to price stability in Western countries. That resulted in large unrealized losses on fixed income securities in the held-to-maturity portfolios of some of these commercial banks. Now, the poor management of interest rate risk from the point of view of the banks led them to a very weak position. On top of that, the supervisory, and I'm basically quoting, the main conclusions from the Fed forensic analysis, as well as the BIS report on lessons learned from this exercise. Second, supervisory intensity and speed of action in response to those identified weaknesses allowed them to persist unaddressed for too long in these banks. So supervisory lessons are also there. And third, the perceived stability of the bank's existing shareholders. The perceived inability of the bank's existing shareholders, other bound by their own large exposure limits, to further support these ailing banks also threatened significant capital shortfalls in the banks. So banks with concentrated deposit base and significant amounts of large uninsured deposits proved particularly vulnerable to those shocks and became subject to deposit runs or sharp lumps in the share prices. That then later on got compounded with additional concerns on other parts of the balances of the banks, particularly in the United States, more linked to commercial real estate exposures that had shown vulnerable to structural as well as short-term challenges. Now, the immediate regulatory response to these events was to increase transparency about the bank's exposure and deposit concentration. In the EU, as we know, no bank became a victim of a bank run or a sustained fall in their share price as a result of these incidents. To my mind, this is in part thanks to the fact that in the EU, the Basel standards for capital and liquidity, and it's particularly the interest rate risk in the banking book management under Pillar 2, are applied at all banks across the system, and not only for the largest players. As we're now starting the implementation of the last round of the Basel reforms, I think the strength of the EU banking sector is deemed to be further enhanced, and this should be a lesson that we keep in mind as we continue to push on that agenda to finalize the reform. Now, despite the fact that the EU banking sector remained robust, and the results of our recent policy stress test back at the end of July of this year indicate that this would be the case even in more severe downward risk scenarios. We also took the advantage to do a transparency exercise on the held to maturity portfolios of the banks in the sample and show what were the size of those held to maturity portfolios, as well as what were the amount of the hedges linked to that and the amount of unrealized losses in the European banks related to those portfolios. However, the current complex macroeconomic and geopolitical environment may give rise to new rises of unprecedented types and difficulties. Now, the implications for the economy and for the financial markets from those potential shocks, and also from the shock that we have already know are there, particularly the rise on interest rates that continue to trickle down through different parts of the economy, are still yet not fully understood. In addition, as I said, geopolitical shocks have also increased in fragmentation of globalization and continues to surprise us with risks to the downside. So we should therefore remain on a constant lookout for potential vulnerabilities and possible trigger events. Among these, let me justify and identify some of the most directly impacting the EU banking sector according to our risk assessment. As I mentioned, the current complex macroeconomic and geopolitical environment makes sure financial markets and overall economic activity in ways difficult to assess. That's a very important shock. Second, despite the recent profitability enhancement, we know the banks will be challenged to sustain their earnings at the current levels amidst the repricing of the liabilities and the higher operational expenses that are likely to come as inflation trickles down into the economy. Third, also the observed slowdown in bank lending, which is already clear materializing, will also reduce the potential for banks to earn additional profits. Recent bank lending surveys indicate that the demand for loans has significantly weakened because of the higher interest rates and increased cost of living. I would call that part of the intended consequence of the monetary tightening of the central banks. And in parallel, banks have tightened their lending standards as a response to the heightened macroeconomic and geopolitical uncertainty, and obviously an anticipation of potential deterioration of loan quality as interest rates increase and the economy weakens. Now, weak profitability has been, as we know, a lingering vulnerability for EU banks for many years. However, unfortunately, I would say, based on the latest figures that we published here at the EBA risk dashboard, last performance has been quite good. The return on equity of the EU banks has reached 10.8% in the second quarter of this year. That's the highest figure report since the great financial crisis. And I'm willing to say, I'm looking at Lars here, that it's also since the beginning of the EBA. The improvement in profitability is almost solely due to the increase in the net interest income, which has recovered by more than 20% year on year, mostly driven by an increase in interest rates, as I mentioned before, which has supported this bank's net interest income. Also, contributing to the improved profitability, banks' average cost-to-income ratio has declined from 59% to 56.5%, reaching an all-time low, as banks have managed at the same time also to control their expenditures while net interest income was going up. Now, going forward, as I said before, we can expect these gains to be moderated as the remuneration the banks are paying to their deposits is gradually going to increase, and the spread between lending and deposit rates, I would think, will normalize. The high interest rates have also revealed important structural difference across the banks in the European Union, as the benefits have been unevenly distributed across the Union, depending on the structure of the bank's balance sheets. On the one hand, banks whose loan books are predominantly variable interest rates have seen their net interest incomes increase very rapidly, while those with loans and fixed rates have seen more moderate improvements. On the other hand, the adverse impact that high rates will over time have on the bank's borrowers will be also more muted for the fixed rate lenders. A regular monitoring of these risks and vulnerabilities and the trigger events, as well as understanding of the channels of shock transmission and possible hidden unknown pockets of risk, is crucial in the period ahead as we go forward. For this reason, I think financial stability analysis has been identified as one of the key priorities for the EBA in our work program that we publish for next year. Now, this policy research conference for today and tomorrow promises to contribute to this work in a meaningful way. So in the next 2 days, you will be hearing from leading academics about their working areas such as banking regulation, liquidity risk management, liquidity risk and the bank security portfolios, funding liquidity, credit lines and asset pricing, interest rate risk and asset liability management, as well as liquidity and leverage in banking and fintech. Now, I just mentioned fintech, which is one aspect of the conference, which I have not mentioned throughout my speech, which is underlying many of these macroeconomic drivers and short-term trends. There's also more longer-term trend driven by technology. And as we think about particularly the liquidity implications of the lessons that we learned in the last 9 months, as well as the liquidity implications of the lessons that we think we can extract from the technological developments going forward, we will expect that it's a much more preponderance of possibility of ability to move higher and higher amounts of liquidity in shorter and shorter amounts period of time. And that puts pressure on any business model, which essentially is based on the idea that there should be liquid transformation within the context of its balance sheet, which is, of course, as you all know, at the core of the banking sector. So that's another aspect I think we will need to reflect further. Particularly in terms of the conference for today and tomorrow, I look forward to the lectures of our two renowned keynote speakers. Right after my introductory speech, we have here Professor David Landon of the Copenhagen University, which presents his work under the title of Bank Equity Risk. Tomorrow morning, Professor Raghu Rajan of the Chicago Booth School of Business will be talking about monetary policy, balance sheet management, liquidity, and financial stability, which I'm sure will be very interesting as well. I'm sure that these influential presentations will greatly enhance our understanding of the past, present, and future, and help us to prepare to the events that may lie ahead and we still don't know. On behalf of myself, the organization committee, particularly the people that have been very directly involved in running this conference this year and many of the years behind that, I would like to welcome you. I would like to thank all the people that are willing to participate in the program and enlighten us with their comments. And I wish you all a very stimulating 2 days of working with us here in Paris. So thank you very much for your presence, and I look forward to a discussion. Thanks.